Hi, this is David Roach, and today I want to talk to you about the latest Fed appointments by the Joe Biden administration in the United States. Jerome Powell has been reconfirmed as the chairperson for another 4 years, and Brainard has been confirmed as the vice chair. Now, Lael Brainard is, of course, a Harvard PhD, very qualified economist. I think there's very little difference between her and between Jerome Powell as regards economic policy. There are other appointments which have to be made. For example, the current vice chair, Richard Clarida, is leaving, and the vice chair of supervision, Ronald Quarles, is also leaving. So there are 2 seats. There are a total of 5 seats which have to be filled because there's one governor seat which is already empty. So we have filled 2, and we have to move on to fill another 3 next year. And the president has said that, or the administration has said, they will do so by the early December. Okay, now I think the key thing about this appointment is that it gives continuity. Markets love continuity, but the ground has shifted under what Powell and Brainard stand for. They are certainly, in historical context, very dovish Fed leaders. Brainard is basically a labor market economist with all what that implies as regards her priorities. And Jerome Powell already has a track record as being very, very dovish, and very much the man who coined the phrase of all the problems about prices and inflation being transitory, which of course has turned out to be dead wrong. However, what is clear is that the ground has moved and the Fed has moved, and that now both Brainard and Powell stand for, first of all, tapering, to be further defined on December the 15th, and second of all, tightening of monetary policy by increasing Fed fund rates, probably starting in the first half of next year. So in a sense, although maybe 6-9 months ago, these appointments would have been seen as being very dovish and a license to print more money, it is actually now not the case. If the Fed were to, the Fed has got a dilemma in front of it. First of all, the Biden administration continues to spend vastly more money than it receives in taxes, and this is going to get even more extreme with the current passage of bills going through both houses. And the Fed is de facto financing this by continuing to buy, albeit in the future at a lesser rate, government securities and keeping interest rates very low. So the Fed is a dilemma. Does it finance the inordinate spending of the federal government, or does it fight inflation? Now, I really don't think that's a choice. I think the Fed will fight the inflation, albeit coming from behind. I don't think the Fed is ahead of the curve. It's behind the curve. But nevertheless, it is now going to try and catch up. And that means next year, we will see less government bonds being bought, less US Treasuries being bought. We know that already. And we will see at least 2, probably more, increases in Fed fund rates starting probably towards the end of the second quarter of next year. Now, what does that actually mean for your pocket? What does it mean for your portfolio? Well, it means this. I don't think that macroeconomic variables like monetary tightening happen before they happen. In other words, I think markets are very poor at anticipating the consequences of less liquidity on securities prices until the liquidity actually gets less. And I think that's going to happen this time. So my feeling is that bond prices, US Treasury yields, will continue to move higher. The 10-year yield, say, at 250 in a year's time, maybe more, and the Treasury and the 30-year Treasury close to 3%, and also maybe more. So that will obviously tell you one thing for sure, and that is that holding US Treasuries is not the right place to be because the yields go up, the prices go down, you lose money, at least until you're repaid at maturity. But the second thing is, I don't think that this is neutral for equity markets. Theoretically, of course, if you raise the long-term interest rates, you raise the discount factor for future dividend streams for equities. And what we saw when these appointments to the Fed were announced, and when the market woke up to the fact that this actually was not the key to more money printing, but to a tightening of policy, was that the sectors in the equity market with the lowest yields suffered the most. Now that is logical, because essentially if you discount very low yields, which only materialize far out in the future, by an increased interest rate discount factor reflecting increased interest rates, then the value of that security today, the value of those future streams, will be less than, say, a utility paying out 4 or 5% in whatever country you want to choose, where you get paid, you start getting paid this year, next year, and so on. In the case of tech stocks, any future payment, if there is one, is way out in the future. And therefore, the value of that payment today falls by more than that of a stock which has a higher yield, because it is worth less as interest rates go up, because the discount value reduces future values more than it reduces near values or present values. So the market reaction was actually an indication that the new role of monetary tightening will not only be limited to the bond markets, as it kind of has been in the past year, but will now start to spill over into equity markets. So beware and conservative. The second thing which these appointments influence is, of course, currency markets. Right now, at the moment, the biggest game in town is that of having, of saying that you buy the currencies of the countries with or economic areas with the highest growth and with the highest inflation, because they are the most likely to tighten monetary policy and raise interest rates. And of course, if you are sitting in Germany, you don't really care whether the US inflation rate is 5, 6, or 7%, as long as you get paid more than you get paid by holding a German Bund, which has a negative yield. So the yield pickup rather than the real yield pickup, it's just the yield pickup supports currencies at the moment. And because the US has the strongest economy, Japan is busy going nowhere with a new prime minister who doesn't have a clue what he's doing. And Europe has got another wave of COVID, which may well spread, but at the moment it's hitting European growth, not US growth. Therefore, the US dollar is seen as the currency which will benefit most for foreign investors from increasing yields, because they will get paid more, and where returns on assets in general will be higher because the economy is stronger. So for the moment, the US dollar is leaving the European currency, the euro, at the gate. It's making the pound look almost as sick as its leader. And of course, the yen is pushing up through 115, which it thoroughly deserves to do. That will go on until such time as it becomes evident to market that the key to sound currency investment is not really simply growth and yield, but how that growth is achieved. And if it is being achieved through a temporary bounce back from COVID, and worse, through excessive fiscal spending, then that fiscal spending will incur bigger budget deficits. Those deficits have to be financed. The US has now got a declining savings rates, because declining savings rates are what is fueling the recovery in the US economy in terms of demand. And the US will become dependent increasingly on foreign investors to fund its budget deficits. When that happens, the dollar will reverse, because then you will need not only to have a higher yield on US assets than you have today, but you will also need to be sure that that yield will not be diluted by a declining dollar. So before the investment flows in to fund the budget deficit, the dollar has to be at a rate where foreign investors say, okay, well, I'm going to get the yield, which I do, is not going to be diluted by the dollar going down in value against my currency, because the dollar's already gone down. So what happens is the deficits, budget deficits in this case, essentially drive, the perception of them changes in marketplaces. The US dollar moves lower, its interest rates remain high, certainly at the long end, and that is what entices investors to come back into the market, or portfolio flows and bank flows to come back into the market and finance the US budget deficit. So there will come a point next year when the very things that are underpinning US growth today, relative to other economies, become not an asset driving the dollar higher, but a liability driving it lower. Thank you for watching this video. If you like it, please give us a subscribe, and goodbye, good night, and don't turn off the lights. Bye-bye.